This part could potentially save you hundreds of thousands. This is my big piece of advice. Number 5, choose low fee mutual funds. There are 2 types of management of these mutual funds and ETFs. You've got active management and passive indexes. Each of these mutual funds have hundreds of millions and billions of dollars all acting in unison, and they're buying. And when you're buying one share of that mutual fund account. There are teams of people that make decisions according to the prospectus and the plan of the fund. Actively managed funds have teams of people doing massive research to try and make money in the market. They're constantly buying and selling stocks, making bets, capturing gains, cutting losses, taking stands, long or short, in different sectors. Active managers are sometimes right and sometimes wrong. But research is starting to imply that active managers get it wrong far more often than they get it right. So active funds have lots of betting going on. They're capturing gains, releasing losses. They're making opinions about sector growth. These funds are simply managing to their predetermined. And then besides those, you have what's called passive index funds. Instead of active management, you have passive index fund. These funds are simply managed to their fund prospectus, or what's called a predetermined index. They don't make bets and they don't mess around at all. They buy what's on the index list and that's it. They are passive. So here's the deal on active versus passive funds. This is a hot debate. Wall Street and mutual fund managers, they make way more money when they are making bets and doing active trading, like way more. Wall Street makes more money on actively traded funds because they're making bets, but research is implying that the overall returns on these actively traded funds are lower than those in the passive indexes because there's an opportunity cost. They get it wrong. So if Wall Street wants to attract people's investment to their best paying products, what do you think they do? They pay their salespeople large commissions on the more profitable actively traded funds. So Wall Street jacks up the internal fees of the funds, and those fees go to pay everyone from the investment advisor down the street to the actual team managing the fund. So actively traded funds are way more expensive for customers. And research is showing that in spite of what the salespeople claim, they actually get returns on average that are lower than these passive index funds. Since index funds don't have that much going on inside of them, and they're not paying big old commissions or salespeople to help them sell, they have far lower internal fees and upfront fees. And these little differences in fees can drastically change your retirement picture. I'm talking big time here. So here's a quick example. Let's say you buy a mutual fund from a good company, but it's actively traded. And maybe it's in an account, maybe with an additional fee or something. And it costs you 1.3% every year versus a 0.3% Vanguard S&P 500 index fund. That's 1.3% versus 0.3%. That means you lose 1% in earnings. So let's look at our previous example. You're 25 years old. You're investing $500 a month till you're 65. Investor A is going to get 7%. Investor B is going to get 8%. Investor A would have a portfolio of 1.3 million. Investor B would have 1.7 million. That's a $430,000 difference. That 1% is a very big deal. Part of why that's so exaggerated is because we're starting at 25 going to 65, but it applies at any length. But that's just a generous example, folks. Here's the dirty truth. When I was in the industry, investment advisors were pointing people towards products that would have much higher internal fees and had actually lower returns than what I'm showing here because the actively traded funds, they just get it wrong. Trust me. Ask a financial advisor and press them on it, and they'll end up showing you historical results of their managed portfolios that are way lower than the indexes, almost always, particularly when you consider the net after all the fees. Most of the time, if you were seeing a potential return of 8% in the portfolio, when you did all the math, you'd probably be earning 5.5%. I'm not exaggerating here. Your wrap accounts and low-quality mutual funds have this all the time. So 5.5% versus 8% at $500 a month from age 25 to 65, this is amazing. That 8% would be a $1.7 million portfolio, where at 5.5% you'd be earning $870,000. That's an $874,000 difference. And I'm not exaggerating here. This dirty little secret is something that the industry does not want you to know. I see regular old people rolling over their accounts into these wrap accounts or just lower caliber mutual funds where the fees are way higher, and then they get convinced to save even more money. The only advice that was actually really given was that they should go into an asset allocation fund. When you start doing the math, these funds have horrible returns compared to the S&P 500 indexes and then low fee funds from Vanguard.